Let me ask you a question. How many software vendors does your company currently pay for? Take a moment, think about it. Most finance and procurement leaders I've worked with estimate somewhere between 40 and 70. The actual number, when you do the audit properly, is almost always between 2 and 4 times higher. Shadow IT, departmental purchases made without procurement involvement, subscriptions that started as a free trial, someone put in a credit card, and they've been renewing automatically ever since. In this episode, I'm going to walk you through the exact process I use to audit a SaaS portfolio from scratch, how to find every tool your company is paying for, how to measure whether anyone is actually using it, and what to do with that data before your next renewal. Let's start with the most important question. Where do you actually find the data? There are 3 data sources you need. Used together, they give you a complete picture. Used in isolation, each one leaves a significant blind spot. The first source is your ERP and invoice repository. Every SaaS tool your company pays for appears on an invoice, because invoices are costs, and costs are required for tax and accounting purposes. This is your baseline, the floor of what you're paying. Go to your accounts payable system and pull every vendor payment from the last 12 months. Here's a practical tip. Your accounting team may have already done part of this work. Most finance teams categorize software subscriptions under a single cost category: SaaS, software licenses, or technology. Start there. And if you need to speed up the categorization work, AI tools are genuinely useful here. Upload a CSV of transactions and ask the model to categorize by vendor type. What used to take 2 days takes 2 hours. What you're building is a master list. Vendor name, annual cost, cost center, renewal date, contract owner. This is your foundation. The second source is your IT team and SSO directory. Once you have the invoice list, go to IT. Your IT team has a list of sanctioned applications, tools they manage, provision access to, and support. Cross-reference this with your invoice list. But here's the more important reason to involve IT, the SSO directory. If your organization uses single sign-on, your IT team can see every application that employees have authenticated against using their corporate credentials. That data is a goldmine. We'll come back to it in detail in a moment. The third source is where it gets interesting. Your invoice list shows what finance approved. Your IT list shows what IT manages. But neither captures the tools that employees bought themselves, with a personal credit card, expensed later, or through a departmental budget that bypassed procurement entirely. This is shadow IT, and in most organizations it represents 15 to 30% of actual SaaS spend. There are dedicated tools built specifically to detect it. The category is called SaaS Management Platforms. The leading ones are Zluri, Xylo, Tori, Productive, Better Cloud, Cloud Eagle, Nudge Security, and Korma. What these tools do is monitor 2 signals: your Azure Active Directory or Google Workspace login events, seeing which applications employees authenticate against, and browser extensions that capture corporate email usage across web applications. These are tools worth paying for. The savings they surface in the first 90 days almost always cover their annual cost many times over. Even without a dedicated platform, the combination of invoice data and IT's SSO directory will get you 80% of the way there. Start with what you have. A question worth sitting with. When did your organization last attempt a full software inventory? If the answer is never, or more than 2 years ago, the gap between what you think you have and what you actually have is almost certainly significant. Once you have your list of tools, the next question is, who is actually using them and how? For tools connected to your SSO, your IT team can export this data directly. For tools not on SSO, which is a problem we'll discuss in a moment, you need to request it from the vendor. There are 3 metrics you want for every user on every license. The first is last login date. This is the obvious one. When did the user most recently access the tool? Users who have never logged in, or whose last login was 6 months ago are your immediate targets. The second is login frequency. This is the most important metric, and the one most audits miss. Here is why. Imagine a user whose last login was yesterday. On a simple audit, they look active, but their login frequency is 3 times this year. That user is not a regular user. They are an occasional visitor who happened to log in recently. Login frequency tells you the behavioral pattern, not just the most recent event. A user who logs in weekly for 12 months is genuinely dependent on the tool. A user who logs in 3 times a year is not, and should be on a restricted or lower-cost license tier. The third metric is average session duration. This tells you the purpose of the visits. A 90-second average session usually means the user is checking a dashboard, verifying data, or approving a workflow, not actively working in the tool. That is a view-only or read access use case. And as we covered in episode 3 on license tiering, there is almost always a cheaper way to provide that functionality. Now, for tools not connected to SSO, you need to request this data from the vendor directly. Here is what to ask for, in writing, before any renewal conversation. The full user list with email addresses, last login date per user, login count in the last 90 days, and average session duration per user. Most enterprise vendors will provide this. It is your data. You are entitled to it. If a vendor refuses or delays, that is itself a signal worth noting. A vendor who makes it difficult for you to see your own usage data is a vendor who knows the usage picture does not reflect the contract you signed. And make sure your contract explicitly states the right to usage data on request. If it doesn't, add this clause at the next renewal. Now, here is something most procurement teams never notice until it's too late. SSO integration, the feature that lets your IT team manage access centrally and export usage data, is almost always locked behind the highest pricing tier, Enterprise or Business Plus. This is not accidental. Vendors know that SSO access gives you the data to negotiate against them, so they price it as a premium feature. The practical implication: if you are on a standard or professional tier, you may not have SSO, which means your IT team cannot export usage data, which means you are flying blind at renewal. Here is the move. At your next renewal negotiation, ask the vendor to include SSO in your current tier at no extra cost. Frame it as a security and compliance requirement, which it genuinely is. Vendors often agree rather than risk losing the renewal entirely. The final step in the usage analysis is to cross-reference your user list with your HRIS, your HR information system. This match tells you 2 things. First, employees who have left the company but still have active licenses. We covered this in episode 1. Attrition creates ghost licenses. The HRIS match surfaces them systematically. Second, employees who have changed roles internally and no longer need the same access level. A person who moved from sales operations to HR may still have a full operations platform license. The HRIS match flags this automatically. Run this match quarterly. The combination of HRIS data and SSO usage data is the most powerful tool you have for keeping your license portfolio clean between formal audits. A question worth asking your team: do you currently have a process where IT deprovisions SaaS access automatically when an employee leaves or changes role? If not, right now, somewhere in your portfolio, there are licenses active for people who are no longer with your organization. Before you categorize anything, calculate one number for every tool in your portfolio. Divide the annual contract cost by the number of genuinely active users who logged in at least 4 times in the last 90 days. Annual cost divided by active users equals your cost per active user. Here is why this number matters. $30,000 sounds like a line item in a budget. $1,071 per active user per year for a tool that 122 people have access to but never use sounds like a problem that needs solving. Same contract, Different framing, this is the number you bring to your CFO. Now, every tool in your portfolio falls into one of three categories. Eliminate usage below 20% of licensed seats in the last 90 days. No clear business owner, no documented justification. Issue a non-renewal notice. Require the business owner to provide written justification within 30 days. No response means cancel. Rightsize, usage between 20 and 70%. The tool has genuine value, but the contract is oversized. Document the active user count and session data. Approach the vendor 90 days before renewal with an evidence-based reduction request. Negotiate, usage above 70%. The tool is genuinely embedded. Focus on price escalation clauses, flat renewal rate, and right-sizing rights, using the timing framework from Episode 2. When you apply this framework across your full portfolio, one pattern emerges almost every time. Duplicate tools. 2 whiteboarding tools. 2 project management platforms. 3 video conferencing subscriptions. This is not negligence. It is the natural result of fast-growing organizations where departments buy independently. And the categorization exercise is the moment you see it clearly, often for the first time. When you identify a duplicate, go to the winning vendor and say, "We are consolidating our entire organization onto your platform." That is additional ARR for them. Use it to negotiate a consolidation discount of 15 to 20% on the expanded contract. Consolidation is not a cost. It is a negotiating asset. A question worth asking now: how many tools in your current portfolio have a functional duplicate? If you don't know, the answer is almost certainly more than 0. Everything I've described can be done manually, with invoice exports, SSO data from IT, and a well-structured spreadsheet. For most organizations under 500 employees, that is the right starting point. For larger organizations, or those with significant SaaS spend, there is a category of dedicated tools built specifically for this. The leading SaaS management platforms in 2026 are Zluri, Xylo, Tori, Productive, Better Cloud, Cloud Eagle, Nudge Security, and Korma. Each has a different focus. Zluri covers IT, finance, and security in one platform. Xylo starts with expense and corporate card data, making it particularly strong for finance and procurement teams. Tori is built around IT operations with AI-powered discovery. Productive goes deep on usage analytics for large enterprises. Better Cloud is security-focused, best when SaaS governance is a compliance requirement. Cloud Eagle is positioned for mid-market procurement teams. Nudge Security offers transparent pricing at $5 per active user per month, a practical entry point. And Korma is built for fast-growing companies that need visibility without enterprise implementation overhead. If your annual SaaS spend is above $2 million, a dedicated platform almost always pays for itself in the first quarter. Now, when should you run the audit? At minimum, once per year. This gives you a current portfolio picture and surfaces tools that have drifted into the eliminate category since your last review. More importantly, run a targeted review 90 days before any significant renewal. This is your active negotiation window. The data you collect in that window is the brief you take into the vendor conversation. Additionally, every employee offboarding should trigger an immediate license review. Reassign or deactivate. This is where ghost licenses are born, if the process is absent. And quarterly, a lightweight check. HRIS Match Plus SSO Active User Review for your top 10 contracts by value. This takes a few hours and prevents surprises at renewal. A question to close this section. Do you have a renewal calendar that flags your top 20 contracts 90 days before their renewal date? If not, that calendar is the single highest return procurement process change you can make this quarter. Let me bring this together. A SaaS license audit is not a one-time project. It is a recurring process that, once established, runs with minimal effort and generates consistent savings. The 5 steps are straightforward. Start with invoices, your single source of truth. Everything your company pays for appears there. Add the IT and SSO layer, usage data that invoices can never show you. Surface shadow IT, the tools finance and IT both missed. Categorize every tool using cost per active user as your anchor metric. Eliminate, right-size, or negotiate. And act on the calendar. Full audit annually. Targeted review 90 days before every significant renewal. The first time you run this process, the number you find will surprise you. In my experience, organizations running their first proper audit consistently find 15 to 30% of their SaaS spend in the eliminate or right-size category. The second time is faster. The third time is almost automatic. Next week, how to take this audit data into a vendor negotiation and actually move the number. Episode 5 is where the preparation becomes the deal. Free CFO Procurement Toolkit, Vendor Scorecard, Renewal Checklist, and the PDF Guide. Link is in the description. Subscribe if this is useful. See you next week.